Primerica just reported their Q2 2026 earnings, and they actually beat Wall Street's bottom line consensus.
Oh, wow. So a solid beat.
Yeah, a really big one. They reported adjusted operating earnings of $6.41 per share. That is a massive 17% jump over expectations.
Right. Because estimates were, what, hovering around $6.
Exactly, like
Yeah.
$6 to 603, so they absolutely crushed that.
Okay. What about the top line?
So adjusted operating revenues came in at roughly $865.1 million. That's up about 8 to 9% year over year, which is, essentially in line with or maybe slightly beating those mixed street estimates.
Gotcha. So decent showing there, too.
Definitely. But looking ahead, full year 2026 guidance is kind of a mixed bag.
How so?
Well, investment and savings products, sales, the ISP side, they expect that to jump 10 to 15%.
Okay, that's huge, right?
But term life issued policies are projected to decline by mid-single digits, and expense growth is guided at 7 to 8%.
I see. And how did the stock react to all this?
It barely budged. I mean, shares slipped a fraction of a percent, like 0.17% in after-hours trading. So it's hovering right around $320.05, staying near the upper end of its 52-week range.
It's crazy. I mean, imagine absolutely crushing Wall Street's expectations. Your profits jump double digits. You bring in record revenues. Your wealth management arm is just booming.
Yeah.
And the stock market reacts with a giant yawn.
Right.
That is exactly the bizarre scenario Primerica is facing today.
And that is the mission for this deep dive.
Yeah.
We are going to break down exactly why the market reacted with a shrug to a massive earnings beat.
Yeah, it's a really interesting puzzle.
It is. So to do that, we have to unpack the stark divergence in Primerica's business segments. We'll look at the underlying health of their core multi-level marketing distribution engine and, translate the management commentary that you actually need to understand if you're holding this stock.
It means if you're looking at this from the outside, you might assume a headline earnings beat means everything is just firing on all cylinders.
Right, like everything's perfect.
Exactly. But the stall in the stock price points directly to some serious, well-underlined financial crosscurrents. Primerica is currently a company divided.
How so?
You have a booming investment arm that is effectively dragging along a sputtering insurance core.
Okay, well, let's dive right into the booming side of the business first, because the numbers in the investment and savings product segment, or ISP, are genuinely blowout figures.
Oh, completely.
We are talking about record sales of $4.4 billion for the quarter. I mean, that is a 23% increase year over year.
Yeah, and the profitability metrics there are just as impressive. Pre-tax operating income in the ISP segment jumped 31% to top $104 million.
Wow.
And client asset values, they reach an all-time high of $140 billion.
Which is just massive. And that growth isn't just from broader market appreciation, right?
Yeah, right. It's not just the stock market going up. They brought in nearly $400 million in net inflows during the quarter. What's fascinating here is how effectively Primerica has capitalized on the rising demand for fee-based advisory services among middle-income families.
Yeah, because historically that demographic was largely ignored by traditional financial services.
Exactly. Traditional firms tend to focus their advisory efforts exclusively on high-net-worth individuals. But Primerica is effectively shifting its core identity to a wealth management profile for the middle class.
Wait, but if the wealth management side is generating record numbers and they're sitting on $140 billion in assets, why does management even care if the life insurance side of the business is dipping? I mean, isn't a win a win?
You would think so, yeah.
So from an analyst perspective, why is a booming ISP segment accompanied by a lagging insurance segment such a red flag?
Well, it's because of how the Primerica machine was originally built.
Yeah.
And how it generates its leads. Historically, the entire model relied on a Trojan horse strategy.
Okay.
Right. The core legacy product, which is term life insurance, that was the Trojan horse. A representative would sell a basic, easy-to-understand life insurance policy to open the door with a family.
Right, to establish trust.
Exactly. Establish trust, get a look at their household finances. And once the door was open, they would cross-sell the more lucrative investment products later. But now that dynamic is completely inverting. The Trojan horse is breaking down, the insurance door is closing, but the investment window is wide open and basically selling itself.
Okay, let's unpack this because that shift brings us right to the drag on the company. It's like a hybrid car, where the electric motor is doing all the heavy lifting, but the gas engine is starting to knock.
That's a great way to put it.
Right. Because if you contrast that massive investment boom with the term life segment, the picture changes entirely. Operating revenues for term life were essentially flat at $444 million,
Yeah.
and adjusted direct premiums rose a very modest 3.4%. But the underlying volume, the actual engine of future revenue, is cracking.
It really is. I mean,
Yeah.
issued policies plummeted 12%.
Yeah, dropping down to just 78,904 for the quarter. And the annualized issued premiums fell by 9%.
Right. When your core historical product volume drops by double digits,
Mm.
that is a structural headwind.
Exactly. Because the street doesn't just look at the cash you made today.
No, they look at the pipeline of cash you will make tomorrow. A 12% drop in issued policies means a shrinking pipeline of future recurring premiums.
So is the core insurance product actually losing relevance in today's market? Or is the middle income consumer just too strapped for cash right now to buy life insurance?
It appears to be heavily weighted toward the strapped consumer, but with a really specific psychological twist.
What do you mean?
Well, if we look at Primerica's own household budget index, the HBI, there is a very specific macroeconomic pressure at play. The index actually shows that for 9 consecutive months, income growth has outpaced costs for these middle-income households.
Wait, really? So technically they have a little more breathing room in their monthly budgets.
Technically, yes.
Which sounds totally counterintuitive. If they have more breathing room, you would think they would be buying more financial protection, not less.
You would think so, yeah.
Yeah.
But it comes down to household prioritization. They are actively choosing to prioritize paying down high-interest debt and boosting retirement savings over, taking on new recurring life insurance premiums.
So they are putting that extra cash into retirement accounts.
Exactly, which fuels the booming investment segment we just talked about while simultaneously starving the term life segment.
Wow. But if the consumer demand for the product is shifting, the distribution method has to be feeling the pain.
Oh, absolutely.
And the recruiting bottleneck data here is really alarming. Primerica boasts this massive sales force, right? Like 148,612 life licensed reps.
Yeah, it's a huge army.
But new life licenses dropped 15% in Q2, down to just 11,020. And the productivity of those reps is just abysmal. We are looking at just 0.18 policies sold per life licensed rep.
Think about why that 0.18 number exists, though, and what it actually looks like on the ground.
Right.
In a multi-level marketing model, most new recruits aren't professional salespeople. They are everyday people, teachers, mechanics, office workers, just trying to make a side income.
Yeah.
And they usually burn through their warm market, their friends, family, close coworkers, within their first few months.
Right. And then what?
Well, once they run out of aunts and uncles to sell to their production, productivity drops to near zero, unless they can continuously recruit other people to do the exact same thing beneath them.
So the multi-level marketing engine is kind of like a shark. It has to keep moving forward, constantly recruiting new agents just to breathe and make sales.
That's a perfect analogy. The moment recruitment stalls, oxygen to the whole sales pipeline gets cut off.
Yeah.
If we connect this to the bigger picture, this exposes the core vulnerability of the MLM model that critics have been pointing out for years. An MLM relies entirely on continuous exponential recruitment to drive sales. If recruiting stalls, the distribution engine inherently shrinks. It isn't like a traditional company where you can just, launch a new marketing campaign to boost sales.
Because the recruits are the marketing campaign.
Exactly.
Which obviously forces management to find a fix for this recruiting pipeline immediately. And CEO Glenn Williams addressed this directly on the earnings call.
Yeah, he did.
He noted a strategic shift away from large regional events in favor of smaller local gatherings. And the logic makes sense. Inflation has hit travel costs hard.
Right.
By localizing events, they reduce the financial burden on their reps who are, independent contractors paying their own way. So that should theoretically boost attendance and engagement.
It is a really practical move. I mean, the cost of a flight and a hotel room for a weekend seminar has skyrocketed. And if you are a rep only selling 0.18 policies a quarter, you simply don't have the cash flow to justify that trip.
Exactly.
Localizing events removes that friction.
But they also pointed heavily to their upcoming 2027 convention as a major catalyst to revive morale and launch new tech initiatives. And I kind of have to push back on management here.
Oh, Why is that?
Well, a convention that is a year away feels like an incredibly delayed catalyst for a real-time problem. If new licenses are already dropping by 15% today, you can't just tell investors to wait until 2027 for morale to improve.
You make a really fair point.
Yeah.
It highlights the heavy cultural reliance MLM structures have on these massive, highly energized conventions to drive recruitment and retention.
Yeah, they use the spectacle to hype up the sales force.
Right. But relying on a 2027 event to fix a Q2 2026 miss in recruitment volume, well, it does leave a significant gap where things could deteriorate further.
So if their core insurance engine is sputtering, recruitment is stalling, and their main fix is a year away, it begs a massive question. How on earth did they just beat earnings expectations by nearly 40 cents?
Yeah.
The answer isn't in their sales, it's in their financial engineering.
Which brings us to the financial cushion. It's a mix of strategic tax moves, highly disciplined margin management, and aggressive capital return. And that is padding the bottom line while they work through these operational challenges.
So let's break down those earnings boosters. First, there was a $4.6 million tax equity investment benefit. That alone handed them an extra 15 cents per share this quarter.
That's a huge chunk of the beat right there.
Right. Now, management did guide that they won't be buying any more tax credits in 2026, but they do expect similar tax benefits to stretch across Q3 and Q4. But, I think a lot of retail investors hear a phrase like tax equity investment, and their eyes just glaze over.
Completely. It sounds incredibly dense, but the mechanism is actually straightforward.
Okay, how does it work?
So a tax equity investment is basically when Primerica invests capital into a government-incentivized project like a major solar farm or a wind energy grid.
But they aren't doing it because they want to become a green energy company.
No, they do it because the government rewards those specific investments with massive tax credits. Primerica then uses those credits to legally lower their own corporate tax bill.
Got it. It's a completely legitimate strategy, but as an analyst, it changes how you view the earnings report.
Right.
When you see a 41-cent earnings beat and you realize 15 cents of that was driven by a government tax credit for a solar farm rather than actual operational growth in their core business, well, the quality of that earnings beat diminishes.
Yeah.
It perfectly explains why the broader market didn't reward the stock with a massive rally.
Exactly. Quality of earnings matters just as much as the headline number.
The other massive booster is their capital return program.
Yeah.
They executed $135 million in share repurchases this quarter, alongside $37 million in dividends. And we should note they declared $1.20 per share dividend, marking their 16th consecutive year of dividend raises. But the buybacks are what really move the needle on EPS.
Right, because by aggressively buying back their own stock, they're shrinking the pool of outstanding shares.
Right.
Earnings per share is literally just net income divided by the number of shares. If you reduce the denominator, the number of shares, you artificially lift the earnings per share, even if the actual net income of the company stays perfectly flat.
It is financial engineering 101.
Yeah.
And Primerica executes it flawlessly to keep investors happy while they sort out the recruiting bottleneck.
Yep.
But they can only afford to buy back all that stock because of how effectively they manage their margins. Despite the double-digit drop in policy volume, the term life operating margin held remarkably steady at 21.3%.
That's impressive.
And their return on adjusted equity, the ROE, hit a stellar 33.1%, up nearly a full percent from last year. So how do they maintain a 21% margin when the actual sales volume of the policies is falling off a cliff?
Mostly by heavily utilizing reinsurance.
Yes.
Primerica essentially acts as a middleman.
A middleman.
Yeah. They cede a substantial portion of their mortality risk, which is the risk of actually having to pay out a massive death benefit if a policyholder passes away. They cede that to third-party reinsurers.
Oh, I see.
By offloading that catastrophic risk, they drastically reduce the volatility of their own earnings. It effectively transforms their insurance arm from a highly volatile risk-bearing enterprise into something that acts much more like a predictable fee-based business.
That makes a lot of sense.
They collect the premium, pass the bulk of the risk along to a reinsurer, and keep a very stable, predictable margin for themselves.
Okay, here's where it gets really interesting, though. We're looking at the balance sheet, and there is a massive $140 million net unrealized loss on their investment portfolio.
Yeah, that's a big number.
Management insists it is strictly due to interest rate movements, not underlying credit risk, and they intend to hold these assets to maturity. but for you, the retail investor listening to this, is an unrealized loss of $140 million a ticking time bomb, or is it just accounting noise?
It is a critical question, especially in a fluctuating interest rate environment. But to be clear, it is primarily accounting noise, provided management is accurate about their holding intentions.
Okay.
This comes down to the mechanics of bond math. When interest rates go up, the price of existing bonds that were issued with lower interest rates automatically goes down.
Right.
That creates a paper loss on the balance sheet, an unrealized loss.
So if they bought a bond yielding 2% and now new bonds yield 4%, nobody wants to buy their 2% bond unless they sell it at a steep discount.
Exactly. However, because Primerica intentionally classifies these assets as held to maturity, they don't have to mark them to market on their income statement.
Okay.
As long as the underlying issuer of the bond doesn't default, meaning there is no credit risk, and as long as Primerica isn't forced to sell the bond early to cover a sudden cash crunch, they will eventually receive the full face value of the bond when it naturally matures.
So the loss only becomes real if they are forced into a fire sale.
Precisely. And given their massive cash flow generation, the steady margins we just talked about, and the reinsurance contracts shielding them from sudden mortality payouts, a forced fire sale is highly unlikely.
Got it.
The time bomb is diffused by their liquidity.
So what does this all mean? If you are an investor looking at Primerica today, you are looking at a cash-generating machine with a booming wealth management wing that is successfully capitalizing on a massive demographic shift in middle-class priorities.
Right.
But you are also looking at a company structurally shackled to a fragile multi-level marketing recruiting pipeline that is currently showing severe signs of fatigue.
It is a transition story. The market's collective shrug at this earnings report is essentially a waiting game.
Yeah.
Wall Street is waiting to see which force ultimately wins out. The secular growth of their wealth management arm or the structural decay of their legacy insurance recruiting model.
Which leaves you with a fascinating question to mull over as you watch this stock going forward. As the wealth management side of the house continues to eclipse the insurance side in terms of profitability and growth, will Primerica eventually be forced to abandon its massive, low-productivity MLM insurance army entirely?
Oh, that would do something.
Could they eventually pivot to a leaner, purely advisory model? Do they eventually just pull the gas engine out of the hybrid car and go full electric?
It would require a total cultural reinvention of a company that has been built on the MLM model for half a century. The disruption would be monumental.
Massive.
But if the divergence between the two segments continues to widen and the recruiting bottleneck tightens, the underlying math might eventually make that decision for them.
If you want to stay ahead of the market and track how these major shifts play out, make sure to follow the show for our daily earnings coverage, breaking down the numbers you actually need to know.